Welcome back. Today we're looking at a financial analysis titled Finally Profitable, Tilray's Shocking Q1 Earnings Breakdown.
Right, and it's all about that headline number, a $1.5 million net income.
It's a huge turnaround story. We're going to jump right in and assess how the report structures that story and if the analytical depth really holds up.
That's the key, isn't it? That headline, that shocking profit, it's the hook. But the question I have right off the bat is whether the analysis really digs into the quality of that profit.
Exactly. While the report correctly flags the shock of Tilray hitting a $1.5 million net income versus last year's, a $34 million loss.
Something like that, yeah, a huge swing.
The initial analytical framing really needs to be sharpened to reflect the sustainability of that profit.
I think the weakness here is that the current structure, it sort of overhypes that headline net income figure.
It's a classic trap, right? Highlighting the GAT number.
It is. And it does that before really establishing how fragile that profit actually is when you look at other metrics. I'm thinking specifically about free cash flow.
So it delays the skepticism. You're kind of leading the reader down a path of, wow, they're profitable before you pull the rug out.
Exactly. And the goal of the piece seems to be finding the real numbers behind the headlines. But if we have to wait a page or two to get to the negative cash flow, haven't we already lost the core of the argument?
That's a great point. For any serious investor, that net income number is it's almost meaningless without seeing the cash flow right beside it.
So that leads to the suggestion. The analysis should immediately set up that tension between the GAAP profitability and the operational cash burn.
Right from the first paragraph.
Right from the start. That's what makes the argument feel more investigative, more robust.
When a company makes that sudden pivot from years of losses to a tiny profit, the first question anyone asks is
it real? Are they actually generating cash, or is this just like some non-cash paper adjustment?
Exactly. The whole definition of sustainable health is cash flow. By starting with just the net income, the report kind of implies success, only to have to walk it back later.
It's all about GAAP accounting. I mean, you can have non-cash adjustments, depreciation, deferred tax benefits, all legitimate things that can make an income statement look good.
Sure, but they don't reflect operational health. So the moment you introduce that $1.5 million profit,
you have to immediately introduce the cash reality.
Yes. So for a concrete example, it's actually pretty straightforward. Instead of just presenting the $1.5 million net income as the main event, you immediately juxtapose it with the fact that free cash flow is still negative.
And it's negative to the tune of what, 18.6 million?
Right. Now granted, that's way better than the 40 million plus they were burning before.
Of course. It's progress.
But it completely changes the story.
It totally changes the narrative context.
So the opening should pivot from, Tilray is profitable to something more probing.
Something like, Tilray is profitable on paper, but is the cash engine actually running yet?
I like that. A negative $18.6 million free cash flow suggests the operational reality is still complex. That shifts the focus immediately to the fundamental risk. It sets an investigative tone for the whole report.
You're leading with the conflict. And that elevates the whole analysis from just, reporting numbers to a real critical evaluation.
Okay, that's a fantastic point on framing the opening. Now let's move into the operational analysis itself, the segment breakdown.
The detail here is great. You've got cannabis, alcohol, distribution. It's all laid out.
It is, and the report notes two really important parallel issues. First, the company's overall gross margin dropped from 30% down to 27%.
And second, that the distribution business is just massive in terms of revenue.
But while this segment breakdown gives all this great detail, the report needs to explicitly quantify and focus on the causal link between that product mix shift and the margin erosion.
Right. It feels like two separate facts right now when one is actually causing the other.
The weakness is subtle, but it's critical. The report notes, 1, the gross margin dropped 3 points. Okay. And 2, the distribution segment, CC Pharma, brought in $74 million in revenue, but at only an 11% margin.
So it implies that selling more low-margin drugs is causing the problem.
It implies it, but it doesn't foreground it or, more importantly, quantify it. The reader is left to do the math on their own, and that really weakens the reality check section.
Yeah, you can't make the reader do the heavy lifting there. The analysis has to connect those dots explicitly.
So the suggestion is to strengthen that analytical rigor. You need to more explicitly model, or at least discuss, how much that $74 million in low-margin revenue is acting as a drag.
A huge drag on the high-margin parts of the business.
Because that's how you show why the top-line revenue growth, which was up 5% to a record, almost $210 million, is actually pretty misleading when it comes to profit.
Volume growth is great on the slide, but if that volume is in a margin-destructive segment, it's not really a win, is it? It's more of a necessary evil.
So how do we make that drag effect more powerful, more visual?
I think you re-engineer that reality check section. Directly connect the dots. A concrete example would be to just run a quick scenario.
A what if?
Exactly. A what if? Ask the question. If Tilray had managed to increase the distribution segment's margin by just 3 percentage points, from 11 up to 14%, how would that have shifted that tiny $1.5 million net income?
Ooh, I like that. That forces the reader to see the leverage. A 3-point swing on $74 million in revenue is not trivial.
It's not. And showing that calculation drives home how critical operational efficiency is for that one specific segment.
Or another way to do it would be to contrast the segments directly.
Yeah, you could. You could put the high-margin segments, like alcohol and beverages, side by side with distribution.
Even though the margins in alcohol also dropped a bit, from 41 to 38%.
Right, but you contrast that against the sheer volume of the low-margin distribution revenue. It makes the reader see that even a small dip in the good stuff gets completely overwhelmed by the weight of the 11% margin business. It's a classic volume versus value problem.
That's a really powerful narrative. You're turning the segment data from just a list of facts into compelling evidence.
Exactly. Evidence for the central thesis about the quality of the profit. It shows that the $1.5 million was incredibly hard-won, especially with record revenue.
Okay, that brings us to our third point, and this one is more about the report's structure and flow. It's about the 1-for-10 reverse split.
Ah, yes. The split, it's mentioned, but the placement feels off.
It feels off. The structural flow of the analysis is really disrupted by placing the critical context of the split way too early, almost like a financial disclaimer in the intro.
And by doing that, it separates this huge structural change from its actual operational and forward-looking implications.
The weakness is that you're introducing it with that line, if you see the stock at $8 today, and you're forcing the reader to process this non-operational, structural change before they've even seen the fundamental Q1 numbers.
Before the revenue, before the EBITDA, before the $0 EPS break-even.
And then the actual implications, volatility, what it means for institutional investors, that's all discussed way later in the reality check section. It's totally fragmented.
The split isn't a footnote. It's a tectonic shift in the company's valuation and how the market sees it. It completely changes how you read the forecast and guidance section later on.
We're using a catalyst as a disclaimer.
That's a good way to put it. So the suggestion is pretty clear. Consolidate the discussion of the reverse split. Don't treat it as an intro note. Use it as a transitional bridge.
A bridge between what and what?
Between the historical fundamentals, the Q1 performance you just laid out, and the forward-looking market expectations.
That makes a lot of sense. So if we move it, where does it go? What's the optimal spot?
It should go right before the forecast and forward guidance section. And you should connect it directly to the earnings per share analysis, especially that $0 break-even.
Because the split directly affects the share count, which is the denominator in the EPS calculation.
Exactly. Discussing them together gives the full context for the stock's valuation. It just flows logically. The $0 EPS is the final word on current performance per share, and the reverse split is the mechanism that dictates what those future shares are worth.
And from there, the report can naturally transition from that current performance to management's reaffirmed adjusted EBITDA targets. What were they, 62 to 72 million?
Something in that range, yeah. And it also provides the perfect setup for the updated analyst price targets. You have to explain why analysts are suddenly shifting from, say, $2 pre-split to $15 or $20 post-split.
Right. The sequence becomes so much more impactful. You're saying the structural change informs the forward outlook, rather than just being a random fact that distracts from the historical results.
With a volatile stock like Tilray, sequencing the information correctly is everything. You let the reader absorb the fundamentals first, revenue, margin, cash flow. Then you introduce the mechanism changing the stock structure.
And then you can talk about the future. It elevates the entire analysis of the forecast.
It creates a really clear path. Here's the Q1 foundation, here's the new structure via the split, and therefore, here's what management's guidance actually means for the stock price. It's just so much cleaner, so much more persuasive.
Okay, let's wrap up our critique of the finally profitable Tilray's shocking Q1 earnings breakdown analysis.
Yeah, and I want to say, the foundational data collection in this report is superb. The reporting on the core metrics, that $1.5 million net income and the record revenue, it's all really strong.
It is, but implementing these adjustments will really maximize the report's impact by layering in that critical rigor right where it's needed.
For sure.
So we covered 3 key areas today. First, sharpen that opening angle. Immediately juxtapose the small net income with the ongoing negative free cash flow to create that analytical tension from the very beginning.
Second, deepen the analytical rigor. You have to explicitly link the low-margin segment growth, that $74 million from distribution, to the company's overall gross margin compression. And we suggested using a what-if scenario to really show the mathematical drag on that tiny profit.
And finally,